Thinking about taking out a loan or already have one? If you don't know exactly how much it's going to cost you over the next 6 to 12 months, you could be walking straight into a cash flow crisis. In this video, I'll show you how to quickly calculate your loan payments so you can plan your cash budget with clarity and talk to your lender with confidence. I'm Sean. I've been a CPA for 13 years, and now I help service business owners better understand their accounting and finance so they can build their business with confidence. Before we jump in, don't forget to hit that subscribe button and check out my newsletter for some free accounting and finance tools at ledgerready.work. All right, let's jump in. Today, I'm going to show you exactly how to compute a loan amortization schedule so that you can plan exactly how much you want to get a loan for, know how much your debt service payments will be, your principal and interest payments, and exactly how much interest expense you'll incur over the next 6 to 12 months. Now, this is a key component of putting together your cash budget, which I'm going to talk about more at the end here. But let's jump right into how you do this. So here I'm starting with a blank Excel spreadsheet, and I'm going to start putting some information about the potential loan that you want to get here. Say you want to get a loan for $250,000. Put that in there. Interest rate, I'm just going to put 5.5% for now, but you know whatever you think is right. Term, let's say 5 years, and I'm going to put 60. I'm going to put it in months here. So you're going to want to do it based on how often you make payments. So sometimes loans you make a payment once a quarter, or less or more frequently than once a month. So, but in this case, we're going to do it assuming you're making one payment a month over 5 years, so 60 payments, 60 months. Now you're going to compute your payment, and Excel has this neat little function, just PMT. You put the rate in. You're going to want to divide by 12 because that's 12 months. You're computing the monthly rate here. 60 months. PV, that stands for present value, which in this case means the principal of your loan. Don't worry about the rest of the stuff in the function. Doesn't matter for this. So that's your payment. And you see I put negative to start payment. Excel has this funky calculation where if you don't put the negative, it'll show this as a negative number here. It just looks weird. So next, you're going to start building your amortization schedule. So I like to do this and lay all these numbers out here. So I'm just going to scroll down. I'm eyeballing it here until I get to, okay, here we go. All right. Whoops, one more. All right, so I got 60 months. Literally just laying out this whole thing so you can see what the effect of every single payment will be. Okay. Now, a bank will do this for you. They usually include this in your after the loan's originated, they'll include this in your loan documents. But if you're not sure what you can afford and you just want to know before you go to a lender how much it's going to be, this is where this comes in handy. Or if you have a variable rate loan and you want to know, like, okay, if the rate goes down to this or up, what effect will that have? All right, so I've just done a few things here. All I did was drag. This is payment amount. This assumes you have a fixed rate loan over 60 months. So the payment's going to stay the same every single month, assuming you make your payments. If you miss a payment, it'll go up because you'll have late fees and stuff like that. So, but let's just assume you're paying on time and it's a fixed rate loan. All right. First thing you're going to do in month one, how much interest do you need to pay? So it's always based on the beginning balance for that month. So you're going to multiply that by your rate divided by 12 because you're computing a monthly rate. And I'm just going to add these little dollar signs in here. That fixes this so that when I drag it, it doesn't move. It still goes, the formula still looks to this cell. It doesn't move down. Now the payment, the principal part of the payment is the total payment amount minus the interest. So you compute the interest first based on whatever your beginning balance for that period is. And then you just take payment minus that interest, and that tells you how much of your payment for that month is going to be allocated to principal. And then this ending, which I did while I was explaining this whole process earlier, was the beginning for that month minus the principal you just computed. Boom. Now this will be, the next month will be equal to the prior month's ending. And then we're just going to drag this thing. Making sure I got this. Yeah. Oops. Okay, I'm just gonna double check that this is making sense. Yep, okay. So you can see that I did it right because at the end here it shows as 0. If I computed something wrong, it wouldn't amortize correctly. You know, it wouldn't show as 0 balance at the end of the loan's term here. Some loan agreements are a little different. Sometimes you have a big payment at the end called a balloon payment, and what the bank generally assumes with that is that you're going to refinance when you get to that point. I'm not going to get into the intricacies of that today. But I will make a tool like this available, also for free, just like my forecasting tool I currently offer. And I'll have a few examples that I'll likely put on just a few different tabs. This is your fixed rate example. If your rate were to change, that would affect this. And in the tool that I provide, you know, I'll have some steps that show you what to do if you have a variable rate loan. But essentially what you would do is, let's say it resets at the beginning of every year. So this would be year 1 based on 5.5%. If you get to the end of year 1, you'd copy this, paste special, paste value, and that will remove the formulas. And so that this is locked in place. You'll recompute the payment based on the new rate, and then put and then in the new term too, because you've already finished 12 months. So at the end of 12 months, you'll have 48 months left. So you'd recompute using the different rate and the different term, re-amortize it. You know, it's still going to get you down to 0 here, and you know that will show you what the effect of that rate change is. If the rate goes down, your payment's going to go down. And so, you know, if it goes up, your payment's going to go up. So that's how you would do that. Now, as you can see, this is critical for cash budgeting purposes, because using this, you can see, okay, over the next 12 months, I'm going to have to make $57,000 in payments. So obviously the bank's going to give me $250,000. What that is for is, you know, whatever you're using it for. You know, if you're buying a piece of equipment, then you're getting $250,000 cash buying the equipment. So cashing, and then it goes right back out again because you buy that piece of equipment. Now you're on the hook for $57,000 every year in payments, and so you need to decide as a business owner: is my business cash flowing enough, generating enough net cash to pay this? You know, can I pay that? And also, am I comfortable paying $12,600 in my first year of interest to the bank? You know, is it worth it to me? Is that investment worth it? And so this is huge for a business owner to understand and be able to do before you approach your lender, so you know exactly how large of a loan you want to get. Now, a lot of people think that when they approach the bank, they're just going to try to get as much as they possibly can, and that the bank's, you know, going to limit them. But sometimes a bank's risk tolerance is actually higher than yours. And so what I mean by that is they might be willing to lend you more than you're comfortable with. So understanding right from the start how much you can afford and how much you're comfortable with given market rates of interest is a really big deal, so that you don't get talked into a larger amount or something like that. They may say, well, if you do this line of credit agreement, you just pay this servicing fee and the money's there when you need it. And sometimes it's a temptation to do that, so you have that money on the side. But if you don't need it, there's no purpose in doing that. You may think like, oh well, if I don't use it, it doesn't cost me anything. Well, not true. Sometimes the banks will charge you just for having that line of credit availability. So it's important to understand what you can afford, how much total cash payments you're going to have to make over 6-12 months, so that you can build that cash budget. A lot of people are familiar with forecasting your P&L and how your sales are going to be, but not many small business owners think about they're doing the same thing for their cash balance and understanding where your cash balance is going to be in the next 6-12 months. So I wanted to start with this. I'm building up to the cash budget, and I am going to put a workbook together that helps you do that. I've been speaking to a lot of small business owners I know, and they've all told me that they look at a cash budget as more important to them as their revenue and sales financial forecast, because they just want to know how much cash am I going to have in the bank in 3 months from now or 6 months from now. Can I afford an employee? Will I have the cash to pay them? So I'm working on that. And I hope you found this helpful today. Like I said, I'm going to make this tool available to you for free, just like my forecasting tool, which is available at ledgerready.work. When you sign up to my newsletter, you get access to that tool for free. I'm also going to make this tool available for free once I polish it up a bit. And last week I talked about a workbook that I had put together to compute the cost of an employee. I'm also going to make that available. So I'm working through one by one, building up to a suite of financial tools that I hope will help your business. So anyway, that's all for today, and I'll see you next time.